This is a bear put spread. Pretty simple strategy. Basically, you're buying put A, selling put B being with a lower strike price. The time to use something like this is when you think the market will go down, but you're unsure of how low, or you think the market will go down and the straight put option position is very expensive, and you want to be able to get a put option, get the strike price with a closer strike price cheaper. The profit is limited to the difference between the strike prices. At expiration, the break-even is equal to the put side strike price minus the net premium paid for the spread. Okay, what we're looking at here is a feeder cattle chart. And as you can see, feeder cattle prices have been moving higher. You're getting a sell signal, and you're saying, well, but what if it doesn't go down? Like you had many sell signals in the past. So you're looking for a way to participate with limited risk, and limited exposure. So you decide to go to the option market. However, by looking at a 114 put, you find that it's $850, as you can see up here. 114 put, it's costing about 1.7 cents or $850 in feeder cattle. So what you do is you decide to, well, most likely the market will just go down to this area of support right here. So you decide to use a bear put spread and sell a 111 put, collecting the premium of 412. When you buy an option, you pay the premium. When you sell an option, you collect the premium. So in this case, you're cutting your risk as well as your cost in half. Now the risk on this trade, speaking of risk, the risk is if the market is above 114 come option expiration, in which case your risk is limited to the entire premium collected or entire premium paid for the spread. Now the break even on a spread like this is you take the amount you're paying and the amount you're collecting and you subtract it from the strike price. So let's see what happens here. All right, we get filled and you end up paying $512.50, which in feeder cattle is just a hair, 1.2 cents, 1.02 cents. So in other words, this trade will break even at 112.98, which is right in the middle. Well, not really in the middle, but it's right in the. It's right here. So anything below this line, approximately, would be pure profit. Of course, you're looking for the market to be at 111 or lower come option expiration in order to collect the entire 3 cents. Your profit potential is limited to 3 cents between 114 and 111, in which case is $1,500. Playing the chart out to the end, we'll see how the trade is doing. Okay, as you can see, the market goes down. However, and you're profiting. If you get out of the whole trade, it's worth $937, as you can see on the left. Now you're saying to yourself, but wait, I thought I could make 3 cents. Well, you can make 3 cents. Now, one of the drawbacks to this type of trade is there's extrinsic value on the 111. There's more extrinsic value on the 111 than there is on the 114. The deeper this strategy goes in the money, in other words, the lower the market goes, the deeper the put options are in the money, you'll get less extrinsic value, allowing you to get more of that 3 cent spread. Or if there was less time in the trade, as you can see, according to this date, there's still over a month and a half to go. So you could either take the quick profit, which you're almost doubling your money, or wait to see if the market goes lower. This is a bear put spread.
The content of this program does not constitute investment advice. This program is to help enlighten you to the opportunities for further education and training techniques by industry leaders. This should not be considered as a solicitation to buy, sell, or invest in securities, options, futures, or Forex. Remember, trading does involve the risk of loss. Past performance is not indicative of future results. Stocks, futures, options, and Forex trading is not suitable for every investor. Please consult a professional regarding your financial situation before placing a trade.